It wouldn't surprise me to see silver take 2 years to break out relative to gold. It also wouldn't surprise me to see it happen this fall. All I know is that silver doesn't move until a generalist investor comes to the precious metal space. The generalist investor comes to this precious metal space because of momentum established by gold. When that happens, I don't even know why. I suspect it's because of the lower unit cost to buy silver. But when it happens, it's truly dramatic. I've seen it happen 3 times before in my life. And Charlotte, it's been pleasant. If I have to wait 2 years for that circumstance, I've been on Earth for 72 years. I'm okay with 2 years. But those moves are really dramatic. And silver has substantially lagged gold in terms of this move, as it always does in a bull market.
Rick Rule begins with a reminder that might surprise some investors. While people often complain that gold doesn't move, Rick counters with cold hard math. Since the year 2000, gold has returned 9% annually on a compounded basis. That performance beats most asset classes over the same period. But Rule understands the psychology of investors. They want drama, excitement, momentum. That excitement, he says, is building again. The foundation of his gold thesis is elegantly simple. The price of gold tracks people's confidence, or lack thereof, in fiat currencies, especially the US dollar. In Rick's view, the structural weaknesses in the US economy, skyrocketing debt, unfunded entitlement programs, and ballooning deficits, mean the dollar is heading toward a massive devaluation. He compares today's situation to the 1970s, where the dollar lost 70% of its purchasing power in a single decade. Rick forecasts a similar fate this time around. If the dollar loses 75% of its value, gold could easily 4x in nominal terms, maybe 3x, maybe 5x, but either way, the implication is clear. Gold is still dramatically undervalued relative to the risk investors face holding cash.
When people ask me when the gold price is going to move, as you know, I say the year 2000. It's up 9% compounded annually for 25 years. Pretty good record. And they like more dramatic moves, which they've begun to enjoy. My thesis is very simple. My thesis is that the gold price moves relative to people's faith or lack of faith in the maintenance of their purchasing power in fiat currencies, primarily the US dollar. I believe that as a consequence of our debt, our deficits, and the unsustainability of our entitlement program, arithmetic unsustainability, that the US dollar will lose 75% of its purchasing power over 10 years, just like the decade of the 70s. I suspect that the gold price will more or less mirror the deterioration of the purchasing power of the US dollar. Arithmetically, if you believe that there's a causal relationship, if the US dollar declined by 75%, it suggests that the gold price could move up 4-fold. Will it be 3-fold? Maybe. Will it be 5-fold? Maybe. What isn't in dispute to me is that absent a real sovereign default, the US dollar has to lose 75% of its purchasing power to make the on and off balance sheet obligations of the US government serviceable. I suspect that the deterioration of the dollar relative to other currencies will begin to subside. I think that people have been selling the dollar reflexively because they don't like our president. I don't like our president either, but I haven't been selling my dollars relative to other currencies. I think that in a relative sense, which is to say relative to other currencies, the US dollar will do okay over 10 years. I think US hegemony will decline. Doug Casey described the dollar once relative to other currencies as the prettiest mare at the slaughterhouse. And so I would suspect over 10 years, relative to the Canadian dollar, relative to the euro, relative to the renminbi, the dollar will do okay. But in an absolute sense, what you buy with $1,000 today will cost you $4,000 10 years from now. In an absolute sense, it'll do poorly. In an absolute sense, your audience is going to hate me for this, but the Canadian dollar will do a little worse. It wouldn't surprise me to see silver take 2 years to break out relative to gold. It also wouldn't surprise me to see it happen this fall. All I know is that silver doesn't move until a generalist investor comes to the precious metal space. The generalist investor comes to this precious metal space because of momentum established by gold. When that happens, I don't even know why. I suspect it's because of the lower unit cost to buy silver. But when it happens, it's truly, truly, truly dramatic. I've seen it happen 3 times before in my life. And Charlotte, it's been pleasant. If I have to wait 2 years for that circumstance, I've been on Earth for 72 years. I'm okay with 2 years. But those moves are really, really, really dramatic. And silver has substantially lagged gold in terms of this move, as it always does in a bull market.
So really, we should be prepared, and it'll happen sooner or later, but we should be ready.
It depends on who you are as a speculator. There are some people that have trauma holding a position over a long weekend. They should do something else, buy bonds or something, If you're a speculator, and if you're a speculator who can tolerate perturbations, volatility, if you can tolerate for a time boredom, the setup in silver from a speculative point of view, using history as a guide, is spectacular. The nominal highs for silver are $50, but that isn't the real high because the purchasing power of the dollar is deteriorated. If you did constant dollars, the previous high is probably $80 or $85 an ounce. And I would expect personally that silver handily takes out those prior all-time highs. I bought a little bit of the Sprott Physical Platinum and Palladium Trust simply because those metals were priced below the total cost of production. And I bought a reasonable amount of a small exploration company called Bravo, which has made what I consider to be a fairly major platinum and palladium discovery in Brazil, one that looks much more attractive at today's prices than it did a year ago. When I looked at investment options to express my preference for platinum and palladium, life got very difficult. Sibanye-Stillwater is the obvious choice, but there are political impediments to Sibanye-Stillwater in South Africa and the ongoing economic reconciliation in South Africa. The best platinum and palladium company in the world by a country mile is Nornickel, the old Norilsk in Russia. But for various reasons, that's a rough place for an American to invest. And so I haven't been able to express that preference, although I do own some suspended shares in that company from the old days. So in terms of being able to express the work I did, I was able to take a reasonable position in the Sprott Physical Platinum and Palladium Trust in the physical metal. And I was able to buy an immodest, which is to say a generous position in Bravo Mining.
Moving beyond gold and silver, Rick shifts his focus to platinum and palladium, 2 metals priced below the cost of production. That, for Rick, is a clear opportunity. He's invested in the Sprott Physical Platinum and Palladium Trust and a small-cap miner called Bravo Mining, which has made a major discovery in Brazil. The problem with investing in these metals, he says, is that the best assets are in politically unstable regions. South Africa and Russia. South Africa's mining industry faces the threat of nationalization and a lack of capital reinvestment due to political uncertainty. Meanwhile, Russia's war and geopolitical isolation make it a no-go for most Western investors, despite having top-tier assets like Norilsk nickel. In Rick's eyes, the supply risk is real and underappreciated. He also mentions Ivanhoe Mines as a potential standout, especially with their massive platinum-palladium project in South Africa. But again, it's high-risk, high-reward territory.
When I look at the copper market and I look at the oil and gas market, the softness in energy prices, even as production plateaus, tells me that the economy on a global basis is weaker than we expect. Platinum and palladium are economically sensitive. So and I'm not an economist, as you know, I'm a pawnbroker. If the economy continues to deteriorate, likely that softness will extend to the internal combustion engine sales, car sales, and that could impact platinum and palladium prices. Looking longer term, platinum and palladium are likely still selling below the total cost of production. And there are still substantial supply risks. If you think about it, platinum and palladium come from 2 places, really. South Africa and Russia. Neither of those places politically are garden spots. Russia is at war, which is difficult. South Africa has ongoing social challenges that haven't yet really manifest themselves, but I suspect will. In the South African mining industry, first of all, the South African government keeps making noises about nationalizing the mine or increasing the social take. What that means is that the mining companies won't make substantial capital investments in the mines because they don't know who's going to own them. And that means that they substitute labor, cheap labor, for capital. They don't invest in capital equipment for the labor to operate. They don't invest in training. And that means that the laborers aren't getting paid enough money to live. The workers' wages have to go up, but the workers' wages can't go up. Because I don't know how that resolves itself, I don't have the courage to buy those. Perhaps the best expression of that would be the shares of Ivanhoe mines, which have been decimated because of their stability problems in Congo. They are bringing on a new mechanized mine in South Africa with 80 million ounces in reserves and resources. So perhaps the best way to express a preference in platinum and palladium, other than the Sprott product or Bravo, would be in the shares of Ivanhoe mines. The deposit is a spectacular deposit. In fact, I think it's a district. As you point out, there's substantial local favor for the project, both in terms of the native corporation and state politics, but the Biden administration blocked the access road against the wishes of local partners. Mr. Trump is trying to do so many things at once that I have a difficult time understanding the probability that he gets anything done. In my life, if I've had a fight to fight, I fought that one. I took on that adversary. It's very difficult for me to understand, even granted that he's a person who in many regards is superior to me. If I need to fight one fight at a time, he should be fighting no more than 3. And he seems to be fighting 1,000. So the idea that I could assign a probability to his being successful in any one fight is fairly low. My top ASX story is a rare earth story. It's meteoric. Lots could go wrong, and nobody should buy it until they get their financing done. They need to raise 30 or 40 million bucks. That needs to happen. Get that out of the way. What I like about meteoric is, first of all, rare earths aren't particularly attractive to Australian participants or anywhere else, so it's deeply out of favor. The asset's not an Australian asset, so Australian investors aren't focused on it. And it's an Australian domiciled company, so North American investors aren't focused on it, which is to say it's way off the radar screen. And as I told you, I love hate, if not boredom. So it meets that. It's a deposit with, I believe, at least $20 billion in situ reserves and resources, which is a tier 1 deposit. It would be, were it constructed, at least according to the pre-production studies, in the best quartile worldwide in terms of all-in sustaining costs, and in the best quartile worldwide in terms of return on capital, which I love. It's in Brazil, which relative to the countries I invest in is ironically pretty stable. And it's in the good part of Brazil. It's in a part of Brazil that has roads, power, workers, water, all that kind of stuff. It will be at least a 5-year development time frame. So anybody who buys it has to be patient. Bottom line on this, I could easily lose half my money if I'm wrong. Easily. And there's going to be lots of volatility, and it's going to go up and down and up and down. But it is a stock that I think, if things go right, could give me a 10-to-1 return or a 20-to-1 return or a 30-to-1 return. I love tier 1 deposits in out-of-favor commodities. I also like an ASX stock called Sovereign, which is a rutile and graphite developer in Malawi. Those are also commodities that are off the radar screen. Nobody cares about them. Again, ASX listed. Australians don't like it because it's not in Australia. North Americans don't like it because it's domiciled in Australia. Nobody cares about graphite. Very few people can spell rutile. And again, it's an enormous deposit. The third ASX junior I like is Centaurus, which is also in Brazil. And it's in the nickel business. And people hate nickel. They've gotten pounded in nickel. I believe it's the best undeveloped sulfide nickel deposit in the world. So those would be my 3 ASX picks. Deeply, deeply, deeply off the radar screen. There's an exhibitor here called Emerald Resources, which I've held for a very long time. I have a huge position in Emerald. Would I enter it in a big way today? Probably not, but I have huge built-in gains. These are people who built Regis Resources, which was one of the most successful Australian stories in the last decade. They're people I've known and done business with for 30 years. Buy and build strategy, superb guys. So that's something that people could take a look at. if they're not as fond of hate as I am.
Please like and subscribe.